we're going to be conducting a comprehensive examination of really one of the most significant figures in the history of global finance.
Absolutely.
We are looking at the life, the mechanics, and I think the contradictions of Warren Edward Buffett.
And the timing for this is,
Yeah.
it's particularly important. The context here is the early months of 2026.
Right.
As we're having this conversation, Warren Buffett is 95 years old. His net worth is estimated at, around $149 billion.
Which still puts him firmly as, I believe, the 9th richest person in the world.
It does. But the big story, the seismic shift, is that the landscape of his life's work, Berkshire Hathaway, has just gone through its biggest change in more than half a century.
That's exactly right. The transition that the financial world has speculated about for, decades.
Right.
It's finally happened.
It has.
As of January 1st, 2026, Warren Buffett is no longer the CEO of Berkshire Hathaway.
The day-to-day reins have been passed. Greg Abel is now president and CEO. This was set in motion at the investor conference in May of 2025.
Buffett is still chairman, of course. But this is a new era.
It is. It's the end of an era, but it's also the test. It's the test for the machine he built. And we also have to talk about the capital redistribution that's happening at the same time.
The philanthropic side of things.
The sheer scale of it. By the middle of last year, 2025, he had crossed $60 billion in total donations.
And the pledge is still to give away 99% of his fortune.
So that's really our mission here, to move past the folksy caricature, the man sipping a Coke and playing a ukulele.
Right.
We need to get into the ruthless efficiency of his capital allocation. How did a man born in Omaha, Nebraska in 1930 turn a failing textile mill into a global conglomerate?
And to understand that, you have to go back to the beginning. Let's start in 1930.
Omaha.
August 30th. He was born the second of 3 children, the only son of Layla and Howard Buffett. And his father wasn't just a stockbroker.
No, he was a United States congressman, which is a relevant detail. Because that background meant the family eventually moved to Washington, D.C. after his father was elected in 1942. It exposed him to a different world. But his interest in business, that started long before D.C. It started in the Omaha Public Library.
At age 7, he borrows a book, and the title is just perfect. 1,000 Ways to Make $1,000.
And it seems like that book just ignited something in him. It was never just about greed, it was about mechanics, the process of accumulation.
There are so many stories about his childhood ventures, but there's one that really illustrates his entire philosophy in miniature.
The pinball machine.
The pinball machine. It's 1945. He's a sophomore in high school. He and a friend, they pool their money, $25.
Which, you have to put that in perspective. In today's terms, that's roughly $400, maybe $440. It's not nothing for a teenager.
Not at all. And they buy a used pinball machine.
But they don't just, put it in a basement and play with it. This is the key. They place it in a local barbershop.
Right. And the mechanics of this are pure Buffett, even then. He isn't the one cutting hair. He's not doing the manual labor. He provides the asset.
And it's an asset that generates cash flow while he's at school. Within months, they take the profits from that first machine.
And they reinvest.
They buy more machines. Soon they have several machines in 3 different barbershops across Omaha.
It's a perfect lesson in separating time from money. Most people trade their hours for dollars. Even at 15, he was trading capital for dollars.
It's compounding in its simplest form. You take the earnings, you reinvest in the business, you expand your asset base, and then, in 1947, they sell the whole operation.
To a war veteran for $1,200.
Which, in adjusted currency, that's almost $17,000. It's a significant exit for a kid.
And this wasn't an isolated thing. He was doing everything. Selling chewing gum, Coca-Cola, weekly magazines, door to door.
Delivering the Washington Post, which is a nice piece of foreshadowing for a huge investment he'd make decades later.
He detailed cars. He sold golf balls he found. But the thing that really stands out to me is his understanding of the tax system.
At such a young age, yes.
He filed his first income tax return in 1944. He was 14 years old.
And on that return, he did something that implies a very sophisticated mind.
He took a $35 deduction. For what? For the use of his bicycle and his watch on his paper route.
Think about that. That $35 deduction shows a level of financial literacy that most adults, frankly, never achieve. He saw himself as a business. The bike wasn't a toy. It was a depreciating asset he used to generate income,
It's incredible. By the time he was out of college, his savings were at $9,800.
which, adjusted for inflation, is nearly $130,000.
Yeah.
All accumulated through his own ventures before he was really even an adult.
He even bought real estate as a teenager. At 14, he used $1,200 of his savings to buy a 40-acre farm.
And he didn't work it himself.
Of course not. He had a tenant farmer work it. Again, it's the same model. Ownership, not labor.
Which brings us to his education. And this was a point of friction.
He didn't want to go to college.
Not at all. He wanted to go straight into business. He had the capital. He had the drive. But his father, Howard, overruled him. He basically forced him to go.
So he starts at the Wharton School at the University of Pennsylvania, spends 2 years there, wasn't really happy, and transfers to the University of Nebraska. He gets his degree. But the really pivotal moment in his entire education, maybe his entire life, was a rejection letter.
He applied to Harvard Business School in 1950.
And they rejected him.
It was a blow to his ego, he's admitted as much. But it was completely serendipitous. Because after that rejection, he's looking through course catalogs and discovers that Benjamin Graham was teaching at Columbia Business School.
If he had gone to Harvard, who knows? He probably would have ended up on the standard Wall Street track.
Exactly. The rejection steered him toward the man whose philosophy would define his entire career.
And Benjamin Graham he's the giant in this story, the father of value investing.
Graham's whole philosophy was so different from what was happening on Wall Street at the time. He taught that you have to view stocks as pieces of a business, not just ticker symbols flashing on a screen.
And the margin of safety.
The margin of safety. Buying something for significantly less than what you calculate its intrinsic value to be. And back then, this often meant what he called the cigar butt approach.
Explain that.
You find a stock that's like a discarded cigar butt on the street. It's, it's dirty, it's cheap, nobody wants it.
Right.
But it has one good puff left in it.
So you pick it up.
You pick it up, get that last free puff of value, and you throw it away and move on. It's a quantitative approach. You're not looking for great companies. You're looking for cheap prices.
So Buffett goes to Columbia. He gets his Master of Science in Economics in 1951, and he just soaks up everything Graham has to teach.
And there's a story from this period about Geico that shows his tenacity.
Right. He finds out Graham is on the board of Geico Insurance.
So he gets on a train to Washington, D.C. on a Saturday. He goes to the Geico headquarters. It's locked.
He just starts knocking.
Pounding on the door until a janitor finally lets him in. And once he's inside, he finds the only person working that day, the vice president, Lorimer Davidson.
And most executives would have thrown a college kid out on the street.
But Davidson didn't. They sat and talked for hours about the insurance business. Buffett wanted to understand everything, the premiums, the risk, the float. He made his first purchase of Geico stock right after that meeting.
And Davidson later said he knew Buffett was an extraordinary man after just 15 minutes.
But even with that promise, when Buffett graduated, he hit another wall. He wanted to work for Graham. He even offered to work for Graham Newman, the partnership, for free.
And Graham said no. He'd turned down free labor from Warren Buffett.
Graham's reasoning was that he was trying to save the few spots in his firm for Jewish analysts who were facing a lot of discrimination on Wall Street at the time. So Buffett goes back to Omaha. He works for his father's brokerage for a bit.
He even taught a night class on investment principles
to students who were twice his age. But then finally, in 1954, he gets the call. Graham hires him.
So he moves to New York. But it doesn't last that long. In 1956, Graham decides to retire and closes the partnership.
Which brings us to the next chapter, the partnership era.
He goes back to Omaha in 56. He's got a good amount of savings by this point, over $170,000.
And he decides to start his own investment partnership. He gets about $105,000 from 7 limited partners, family, friends.
And how much of his own money does he put in?
Just $100. $100. It was symbolic. He wanted his partners to know his primary motivation wasn't his own small stake. And this period, from 56 to 69, is where he builds his track record. And we start to see his style evolve. He wasn't just a passive stock picker anymore.
He became an activist. The Sanborn Map Company deal in 1958 is the perfect example of this.
It really is. Let's break that down.
Okay, so Sanborn Map. In 1958, the stock is selling for $45 a share.
Right. But the company also owned a huge portfolio of other securities, an investment portfolio. And that portfolio alone was worth $65 for every share of Sanborn stock.
So the market was valuing the actual map-making business at negative $20.
It was completely irrational. And the old Buffett, the pure Grahamite, might have just bought the stock and waited for the market to figure it out. But he didn't.
No, he bought 23% of the company's outstanding shares. He got himself a seat on the board.
And then he allied with other unhappy shareholders until they controlled 44% of the stock. He forced the board to unlock that value, to use the investment portfolio to buy back shares.
He made a 50% return in 2 years.
It was aggressive. It was hostile, in a way. It shows that he was willing to force the issue if the math was on his side. This was not buy and hold investing.
It was also during this time, summer of 1959, that he was introduced to a man who would change his life.
Charlie Munger.
At a dinner at the Omaha Club.
And that meeting, you could argue, changed the trajectory of modern business. Munger was an attorney then, but his mind was just as sharp as Buffett's. And he's the one who eventually pushed Buffett away from the cigar butt strategy.
Away from buying just cheap, fair companies.
And toward buying wonderful companies at fair prices.
Yeah.
But before that philosophy really took root, Buffett made what he himself calls his worst trade ever.
The acquisition of Berkshire Hathaway.
It is the great irony of his life. The vehicle for all his success is named after his biggest mistake.
In 1962, what was Berkshire Hathaway?
It was a textile manufacturer in New England, a dying business. The whole industry was moving south, or overseas where labor was cheaper. Buffett started buying shares simply because they were cheap, a classic cigar butt.
The stock was trading around $7, $8.
Right. And the company was run by a man named Seabury Stanton. Stanton saw Buffett accumulating shares and wanted to buy him out.
So they have a verbal agreement. Stanton will buy back Buffett shares at $11.50 per share.
But then the written tender offer arrives in the mail. And the price isn't $11.50. It's 11 3/8. $11.37.5.
He shaved off an eighth of a point.
That 1/8 of a point changed history. Buffett was insulted. He felt Stanton was trying to cheat him, to squeeze him for pennies dishonestly.
So instead of taking the offer and selling his shares?
He did the opposite. He started buying more shares, aggressively. By 1965, he had a controlling interest in the company. And at the very next board meeting, he fired Seabury Stanton.
A victory, but a hollow one.
A completely Pyrrhic victory. He now owned a controlling interest in a terrible business in a dying industry.
And he kept those textile mills running for another 20 years.
Tying up capital and low-return assets. He's estimated that this emotional decision, this mistake, cost him and his shareholders hundreds of billions in opportunity cost. But he did make one absolutely genius pivot.
He used the cash flow from the dying textile business.
While it still had some, yes. He used that cash to start buying into the insurance industry. He bought a company called National Indemnity.
And this is where we have to talk about float. This is the secret sauce, the engine of Berkshire Hathaway.
It's everything. Insurance is a unique business. Your customers pay you up front. Those are the premiums.
But you don't pay out claims until later, sometimes much later.
Exactly. And in that time between collecting the premium and paying the claim, you hold the money. That money is the float. It's essentially an interest-free loan from your policyholders.
In fact, if you're a good underwriter, it's better than interest-free.
Much better. If your premiums exceed your claims and expenses, you actually get paid to hold the money. So Buffett could take this massive, ever-growing pool of capital, this float, and invest it for Berkshire's benefit.
So while other investors have to borrow money and pay interest to get leverage,
Buffett was getting paid to use his leverage. This structural advantage is the single biggest secret to Berkshire's long-term outperformance. It's a perpetual motion machine for capital.
So he transforms Berkshire from a textile mill into a holding company, powered by this insurance float. And as we get into the 70s and 80s, you see him start to build the conglomerate.
One of the first major pillars was media. In 1973, Berkshire started buying stock in the Washington Post Company.
And this wasn't just a stock purchase for him.
No, it became a deep personal friendship with Katharine Graham, the publisher. He joined the board, he became her mentor on the business side of things, and he understood the business itself.
The moat.
The protective moat. In a world before the internet, a dominant city newspaper was basically a monopoly on local information and advertising. If you wanted to sell a house or a car in Washington, D.C., you had no choice. You had to go through the Post.
That pricing power is what he loved.
It's exactly what he looked for. He did a similar thing with the Buffalo Evening News in 1977. Bought it, entered a newspaper war with the rival paper, and eventually won when the other one folded.
Then came the really big media deal. Capital Cities buying ABC in 1985.
A huge deal at the time, $3.5 billion. It was minnow, swallowing a whale.
ABC was 4 times the size of Capital Cities.
And Buffett was the one who made it possible.
He helped finance the deal. In return, Berkshire got a 25% stake in the combined company. This is Buffett operating at a whole new level. He's not just a stock picker anymore, he's a kingmaker, shaping the entire American media landscape.
And around this time, we have to talk about Coca-Cola. A huge investment in 1988.
This is the definitive, wonderful company at a fair price investment. This is the full Munger effect.
He started buying in 88, eventually spent just over $1 billion for 7% of the company.
He saw the brand, the global dominance, the incredibly simple economics of selling sugar water at a huge margin. It became one of Berkshire's most successful investments ever, and they still hold it. It really marked that final shift away from the obscure, cheap cigar butts of his youth. He realized a brand like Coke had a share of mind with consumers that was an even more powerful moat than a newspaper's distribution network. But the 90s brought a crisis, a huge one that threatened his most valuable asset, his reputation.
The Salomon Brothers scandal.
Berkshire had bought a big stake in the investment bank Salomon Inc. in 1987.
12%. And in 1991, news breaks that a rogue trader at Salomon, a guy named Paul Moser, had been illegally bidding in treasury auctions to corner the market.
And the worst part was, the top management, including the CEO John Gutfreund, they knew about it.
They knew about it and failed to report it immediately. The scandal was so bad it threatened to bring down the entire firm. The Federal Reserve was days, maybe hours, away from effectively shutting them down.
And that's when Buffett had to step in.
He stepped in as chairman to save the bank and his investment. He had to fly to Washington, personally appeal to the Treasury to keep the bank afloat.
This is where we get that famous quote of his when he was testifying before a congressional subcommittee.
"Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless."
It's his entire ethos in one sentence.
He managed to navigate the crisis. He saved the bank. But it was a very close call. And it reinforced his deep-seated distrust of the culture he saw in investment banking. He saw how greed and a lack of discipline could rot a place from the inside out.
So moving forward into the late 90s, Buffett is facing a completely different kind of challenge.
The dot-com bubble.
Tech stocks were going crazy. Berkshire Hathaway was massively underperforming the market. And the narrative was that the Oracle had lost his touch. He was a dinosaur.
And he just refused to play. He flat out said he didn't understand the valuations. He couldn't project their cash flows, so he wouldn't invest. It was his circle of competence.
He was openly mocked for missing the boat.
He was. But then the bubble burst in 2000, and he was completely vindicated. He avoided the entire catastrophe. While others lost fortunes on companies with no earnings, Buffett's capital was safe.
Interestingly, though, he did get involved with derivatives in 2002.
He did, which is fascinating because he's the one who famously called them financial weapons of mass destruction.
So what was he doing?
It just highlights his pragmatism. He warns about the systemic risk of these things. But if he sees a specific mispriced bet where the odds are in his favor, he'll take it.
And this was a bet against the U.S. dollar.
A huge one. $11 billion in forward contracts. He was concerned about the U.S. trade deficit. And by 2006, that one bet had made Berkshire over $2 billion. He's not so dogmatic that he'll pass up a good opportunity.
Then comes the big one, the 2008 financial crisis.
While the rest of the world was in a complete panic, Buffett was calm. He wrote that famous op-ed in the New York Times. The title was just, "Buy American, I Am."
And his action spoke even louder than his words. He effectively became the lender of last resort for corporate America.
The deals he cut were just extraordinary. Take Goldman Sachs, September 23, 2008. Right in the heart of the storm, Berkshire invests $5 billion in Goldman.
But this wasn't just him buying common stock on the open market.
Oh, no. This was a custom deal. He bought $5 billion of perpetual preferred stock that paid him a 10% dividend annually, forever, unless they bought him out.
And there was more.
Plus, he got warrants. The right to buy $5 billion of common stock at a strike price of $115 a share. He was essentially making them a high-interest loan when no one else would touch them, and he got a massive equity kicker on top of it.
He did a similar deal with General Electric.
$3 billion in preferred stock, also with a 10% dividend. These weren't charitable acts. They were not bailouts. They were incredibly profitable investments made possible because he had cash and a pristine reputation when everyone else had fear and debt. He charged a premium for his confidence.
So let's shift to the more modern era, 2010 to 2024. The scale of his deals just got even bigger.
The purchase of the Burlington Northern Santa Fe Railway, BNSF.
That was a $34 billion deal.
It was an all-in bet on the American economy, as he put it. It's a simple thesis.
Yeah.
If you believe the U.S. will continue to make things and consume things, you're going to need railroads to move those things.
It was also a way to deploy a huge amount of cash into a hard asset.
And an asset with an incredible moat. You can't just go out and build a competing railroad today. The rights of way, the infrastructure. It's impossible to replicate.
But not all his big bets in this era worked out.
No. In 2011, he shocked everyone by announcing an $11 billion stake in IBM.
Which broke his long-held rule of avoiding technology.
It was a mistake, and he admitted it. He eventually sold the entire position. He said he misjudged how sticky their client base was, how intense the competition was. But you could argue that failure with IBM paved the way for his greatest modern success. Apple. He started buying it aggressively, and it eventually grew to become by far Berkshire's largest single public stock holding.
What changed?
I think he stopped seeing Apple as a tech company and started seeing it as a consumer products company, like Coca-Cola. He saw the power of the brand, the loyalty of the ecosystem. He realized the iPhone wasn't just a gadget. It was an indispensable utility in modern life.
It's a remarkable intellectual pivot for an investor in his late 80s to make.
It shows he was still learning, still adapting, which is not something you see often.
There was also the famous airline flip-flop.
Yes. He had famously hated airlines for decades. Then in the mid-2010s, he bought large stakes in the 4 biggest U.S. carriers.
And then sold all of them during the COVID-19 pandemic in 2020 at a loss.
He just looked at the facts and realized the world had changed overnight. He didn't know if or when air travel would recover, and he feared government bailouts would dilute his equity stakes to nothing. So he just got out.
He took the loss and moved on.
It shows his discipline. When the facts change, you change your mind. You don't hang on because of pride or because you don't want to admit a mistake. You sell.
We should probably also touch on a more recent controversy, the ProPublica report from 2023.
Right. The allegation was that Buffett had made trades in his personal portfolio in the same quarters that Berkshire was buying or selling those same stocks.
The implication being he could be front-running his own company's moves.
The report cited some sales of stocks like Johnson & Johnson and Wells Fargo. Now, Charlie Munger, before he passed away, he dismissed this completely. He said there wasn't the slightest chance Buffett was doing anything to improperly enrich himself. And when you consider that the man is giving away 99% of his wealth, the motive for skimming a little extra for himself seems pretty weak. But the optics of it were certainly discussed.
Okay, so let's try to distill the philosophy that drove all of this. We've mentioned the circle of competence.
Which is just the simple idea that you have to know what you know and know what you don't know. And you stay within that circle. The size of the circle isn't what's important. Knowing where the perimeter is, that's what's critical.
And Mr. Market.
An allegory from Ben Graham. The market is your business partner, but he's a manic depressive. Some days he's euphoric and offers to buy your shares at ridiculously high prices. Other days he's despondent and offers to sell you his shares at absurdly low prices.
And your job is to take advantage of his mood swings.
Exactly. You are there to serve your own interests, not to be influenced by his mood. That psychological discipline to buy when others are fearful and be fearful when others are greedy is the hardest part of his strategy to replicate.
He's also a huge advocate for index funds for the average person.
A staunch advocate. In 2007, he made that famous $1 million bet with a hedge fund manager.
The bet was whether a simple, low-cost S&P 500 index fund could outperform a hand-picked basket of hedge funds over 10 years.
And Buffett won that bet in a landslide. It wasn't even close. By 2017, the index fund had completely crushed the hedge funds, especially after you factor in their high fees.
Which is why his advice to most people is just to buy the index and hold it.
He argues that the fees charged by Wall Street helpers are a huge drag on returns, and that trying to outsmart the market is a loser's game for most people.
He also has this famous disdain for investment bankers.
He hates the fees. He sees them as money shufflers who don't create any real value. He often does his biggest deals with just a handshake or a one-page contract, cutting out the bankers entirely.
Now, let's talk about the man himself. The personal life is full of these fascinating contradictions.
It really is, starting with the house.
He lives in the same house in Omaha he bought in 1958.
For $31,500. It's a 5-bedroom stucco house. He's one of the wealthiest people in human history, and he hasn't moved in nearly 70 years.
What's the signal there?
The signal to his shareholders and to the world is that he is not focused on lavish consumption. His pleasure comes from the compounding of capital, not the spending of it.
His salary was famously capped at $100,000 a year for decades.
Right. Though it's fair to note the company pays for his security, which is substantial. But the salary itself is purely symbolic. It lines his interests with the shareholders. He gets rich if the stock goes up, not from a big paycheck.
And then there's the diet.
The diet is, well, it's famous. He drinks 5 Cokes a day. He loves junk food, sees candies, lots of salt.
His reasoning is that the lowest death rate is among 6-year-olds.
So he decided to eat like a 6-year-old. It just speaks to his very habit-driven nature. Once he finds something he likes, whether it's a stock or a food, he sticks with it for a very long time.
But despite all that frugality, he did buy a private jet.
He did, in 1989. And he had a great name for it at first, the Indefensible, because he'd always criticized other CEOs for that kind of corporate excess.
But he later renamed it.
He renamed it the Indispensable. He realized how much time it saved him, how much more efficient it made him. So it's one of the few luxuries he allows himself, and he justifies it purely on the basis of efficiency.
His personal relationships were also unconventional.
Yes. He was married to Susan Thompson from 1952 until she died in 2004. They had 3 children together. But in 1977, Susan moved to San Francisco to pursue a singing career.
But they never divorced.
They never divorced. They remained married and close, but lived apart. And it was actually Susan who introduced Warren to Astrid Manx, who then moved in with him in Omaha.
So for years, their Christmas cards were signed Warren, Susie, and Astrid.
It was an unusual arrangement, a triad built on mutual respect and affection. He married Astrid in 2006, 2 years after Susan's death. It shows he values long-term, loyal partnerships, even if they don't fit a traditional mold.
There was also a pretty public family disagreement. In 2006, he disowned his adopted granddaughter.
Nicole Buffett, yes. After she appeared in a documentary about wealth inequality called The 1%.
He wrote her a letter that was very harsh.
It was. I have not emotionally or legally adopted you as a grandchild. It showed how sensitive he is to his family name being used for what he perceives as grandstanding or a sense of entitlement. They have reportedly reconciled in recent years, though.
His hobbies are simple.
Bridge. Fanatical about bridge. He plays about 12 hours a week, often with Bill Gates. He says it's the best exercise for the mind. It's all about probabilities and partnerships, which sounds a lot like his approach to investing.
And he plays a ukulele.
A skill he picked up as a young man to impress a girl. It shows a lighter side to him.
We should also cover his views on broader economic policy, particularly taxes.
The Buffett rule.
Right. He famously pointed out that he paid a lower effective tax rate, something like 19%, than his secretary, who paid 33%.
And that's because his income is mostly from long-term capital gains, which are taxed at a much lower rate than ordinary wage income. He's consistently argued that this is fundamentally unfair and that taxes on the ultra-wealthy should be higher.
He's also famously skeptical of assets that don't produce anything.
Like gold and crypto. He compares gold to a pet rock. You dig it out of the ground in Africa, melt it down, dig another hole to bury it in, and then you pay people to stand around and guard it. It has no utility.
He'd rather own a farm or a factory.
Something that produces something. Corn, cars, whatever. As for Bitcoin, he's been even more dismissive. He called it rat poison squared.
Why such a strong stance?
Because he sees it as a purely speculative asset. It has no intrinsic value. Its price is based only on the hope that someone else, the next person in line, will pay more for it than you did. For an asset to have real value, in his view, it must be able to generate cash flow.
Which brings us to today, the final transition, the years 2025 and 2026.
At the annual meeting on May 3rd, 2025, the official announcement was made. Greg Abel, who had been running all the non-insurance businesses for years, was named the successor.
And that transition became effective January 1st of this year, 2026.
The culmination of more than a decade of careful succession planning.
So Buffett is now purely the chairman. The day-to-day operational pressure is gone, and his focus has shifted almost entirely to the final act.
The disbursement of the fortune. This is his legacy project now. In June of 2021, he resigned from the Gates Foundation board. By mid-2025, he had donated another $6 billion in Berkshire shares.
But the strategy for his philanthropy seems to have shifted, too.
It has. He is now funneling massive amounts of capital directly into the foundations run by his three children: the Susan Thompson Buffett Foundation, the Sherwood Foundation, the Howard G. Buffett Foundation, and the Novo Foundation.
So he's ensuring the wealth goes back to society, but through channels that he trusts implicitly, his own family.
It's the ultimate paradox of his life, isn't it? He spent 95 years perfecting the art of capital accumulation, living this famously frugal life, all so that he could give it all away at the end. He built a fortress of money, but he refuses to let it become a dynasty of inherited private wealth.
So as we look at him now, in early 2026, at 95 years old, what is the final takeaway? What's the core lesson?
I think the core lesson is that the basic principles of value investing, of buying a dollar's worth of assets for 50 cents, can work on an unimaginable scale if you have the patience and the discipline. But the really unique part of Buffett was combining that discipline with a mind that could adapt.
He went from cigar butts to Apple.
Exactly. From textile mills to insurance. He survived the inflation of the 70s, the crash of '87, the tech bubble, the financial crisis, a global pandemic.
He's the ultimate survivor. And while Greg Abel has immense shoes to fill, the blueprint that Buffett created is probably the most durable in corporate history.
Indeed. He proved that you can win the game of capitalism and win it bigger than almost anyone else while playing the long game with integrity.
A remarkable story. Thank you for listening to this exploration of the life of Warren Buffett.
Thanks for listening.